Okay, we now have the AVID Investors Club market update. As promised, stuff is going on, you guys. There is just a lot happening in real estate right now. And as you all know, mortgage rates are a big part of the story. Who knows what rates have done, say, today-ish? Up, down, or flat? Any guesses? Down, down, down. Okay. A lot of us know that they did do a small decline, which is key because obviously that really affects your buying power. And as this slide indicates, we kind of extended the lines a little bit, as you see, to what they've done. I added those, but this is your quantity of homes sold and your rates. The bars is your rates and the line is your quantity of homes sold. So these things really do go hand in hand. Mortgage rates significantly affect demand. The laws of supply and demand are constantly in effect in our real estate market, right? We just talked about how things had kind of come to a bit of a screeching halt around fall-ish in October. Why is that? Well, interest rates soared. They soared because the government wants to curb inflation, and buyers watch their buying power really go down. Remember that condo we just talked about in Somerset that just had a little price drop to $384,900, and it's the most affordable ownership in the North End? Somebody tell me what they think that mortgage payment, principal, interest, taxes, and insurance is going to be on that with the 20% down. The starter home, right? I mean, that's a starter home. What's our mortgage payment? Guesses? 18, 37, 25, $2,500 a month, and then you add the $200 for those dues, which cover your utilities. So for those of you who are paying less than $2,500 a month in rent right now, or in mortgage payments right now, that's what your ownership would be if you buy that condo at these interest rates. So interest rates are meant to curb inflation. And when you need a starter home, when you need to come up with $2,500, $2,700 a month to buy it, that's probably happening. And that's kind of part of the story. So here's the word on the street. The word on the street mostly from Title I, Ken Hunter. We love Title I. When you write a contract, you get to put in who you want. Title I, Scott Darling, that's our guy. They give us a lot of great information. So what's going on in the market today, right now? Well, things have people have gotten used to these rates and these payments being high. The market is sort of settled in. It's no longer really experiencing downward pressure. There's factors out there that are favorable for a healthy market. Builders are keeping their inventory in check, which is important because that all factors into that law of supply and demand. So the challenge is inflation eating away at savings, and that Ken Hunter does not yet see a pushback on inflation stopping at this time. But what he says that I think is really relevant to every one of us in this room who has an investor mindset, which means we get to time the market as best possible, is if we are not at the bottom, we are very close. Ken Hunter, Title I. So for those of us who are willing or able to pick something up more affordably, or who want to take advantage of it when prices get pushed down, and who have that mindset where we'll refinance down the road, and we're certainly not going to render ourselves house poor with a payment, this rings of opportunity to me. If someone says we're almost at the bottom, if we're close, that sounds opportunistic. So what I wanted to do is look at some of the big overall trends. In this slide, this line in blue is the number of closed sales that we've experienced over time, with starting in February 2009 and then going all the way to February 2023. And y'all remember what's going on in 09-ish, right? Anyone have an adjective to describe that time?
4 letters.
Never mind. Hold your adjective. 4 letters is the comment from the room. Right. Opportunity. That's a longer than 4 letters. Yeah. Right. So back when we had, I guess, the Great Recession, you can see that this line, I added this one here, which is the number of closed sales. January 2009 was the lowest number of closed sales that we've got in, I guess, semi-recent history. And in July of 2020, conversely, that was the highest amount of closed sales our market had seen. And here we are in March of 2023. Going back to January of 09, we had the lowest number of closings, but in gold, you'll see that we had the highest inventory right before that, 2 years before that. In July of 07, we had the highest inventory. By the way, that July of 07 inventory was 5 times higher than our inventory is right now. Vastly higher. We had a lot of foreclosures going on back then. And then shortly after the lowest ever number of closings, we had the lowest median price of homes in April 2011. Okay, fast forward through a lot of ebbs and flows of the market, which in this number of closings, you really get to see the ebbs and flows of the market here. And we get to July 2020, already said, highest number of closings at 1,402 closings in July 2020. And then in July 2021, we ran out of houses. You remember, if you've been here before, you've heard me say my phone would ring and people would say, hey, I'm an investor from California. I want to buy a house in Boise. And I'm like, honestly, we are out of houses. Do you want me to call you in a couple months if we get some? I literally was telling people we're out of houses. It's just not the time. And we kind of were. Then in April of 2022, last spring, we had our highest median price in history. In June, things started kind of softening up a bit. We then got some interest rates increasing, and things kind of came to a bit of a screeching halt sometime around October. And here we are, March of 2023, with Ken Hunter saying, things are stabilizing. Indicators are that we're not still experiencing that we're leveling out. What a ride, huh? Bit of a roller coaster. So what are prices doing right now? Well, the median prices in 1A, aka Ada County, it's below 500,000. I remember when we were like, oh my gosh, they went above 5, and then oh my gosh, are they at 6? But here we are, we're at 492,000 and some change. And while this is down 10.5% from last March, it is indeed up from 487,000 last month. And so other indicators that the new normal has been reached, I guess, are TBD, but the rates, the supply and demand levels, those are some of the things that will tell. This was the first month since June of 2022 that we didn't experience double-digit declining in the total number of homes sold. Now, our days on market has continued to go up. We're now at 78. I think the last time I presented last month, we were at about 60. And now, let's see, in February 2012, we had not had this many days on market since February of 2012. So that was the last time you had to wait 78 days on average to get your house sold. And at that time, there were a bunch of foreclosures on the market. Whereas right now, foreclosures comprise 0.3% of our sales, with sellers having, and why? Why are foreclosures so low? Sellers have equity. They have credit. So it's a different scene than it was back when we experienced that crash. But for the past several months, particularly, and really in a way since June, buyers have suddenly had the power to negotiate. And they've got options. In July 2021, when we were like out of houses, it was just like, if you needed a house, you just needed a house. There were hardly any options. So they have options. But with that, anyone who's a buyer out there, you've been in the sidelines, maybe you've been waiting and you've been seeing things go down and you're going, I don't know if I want to buy, I need a house, but I'm just kind of taking my time about it. Maybe it's time to, pick your favorite one or close, just based on market data and timing. What about Canyon County? Similar trends. In fact, all of this is very similar in terms of 10.5. Well, this is 10.3% lower median price compared to last year, but it's up a little bit from last month. The only thing that's different really, from a relationship ratio perspective, is the number of homes sold. These are down even more. They're 13.5% compared to like 6.5 or 7% year over year. So things have been different, and it seems like they could be leveling out. I guess that's the big message here. What about duplexes and fourplexes? A lot of us invest in multifamily. Inventory dropped from 11 to 9. So there's not a ton of inventory out there in Ada and Canyon. Pending deals also dropped by a couple. So there's only 7 pendings. And then sales increased a little bit, but without inventory and pendings, they're going to have to dip a little bit next month. So the absorption in fourplexes and duplexes is still at a low number, that below 1 month and only 2 months. That's buyer's market seller's market sort of inventory. So the fourplexes have not been hit as much as single family homes in downward pressure on pricing, and duplexes have been in a full-on identity crisis. I can't even tell you what exactly they're doing. There's just not a ton of them, and they've been a bit erratic. So, and that's common because with duplexes, you're going to have a mix of owner-occupied buyers, and you're going to have a mix of investors, whereas with fourplexes, you've got investors. So investors still have money, and they're still ready to buy. They just want to see the right price. What are the prices and returns doing? So the red line shows a 6-month trailing average of cap rates. And we did have a jump. So the returns went up just a little bit. Tony Drost's quote is, I think a fourplex needs to be at a 5% or higher cap rate based on actual rents. Now, I've been running my performance with actual and market rents for a while, because the rents went up so quickly. If it wasn't rented yesterday, it was, you could get more at the renewal. So Tony's saying we want to look at actual rents. We're not counting on, and he's not saying this, but we're not counting on $200 a month increases at every renewal anymore. That's not sustainable year after year after year after year. And I think things have calmed down enough that won't be the case this year. Now, the gross rent multiplier, we like to look at the ratio to the rents to the purchase price, because it's a real easy number to kind of gauge what you're looking at. You see the price, you see the rents, how do they work together? So conservatively speaking, Tony's baseline has been around 165, but what we're really also seeing on a 6-month trend average is that GRM has been a little bit like, let's see, this month it was close, a little higher than 165. It was at 180 with the downward trend last month. And if you want to figure out your baseline value or what you would pay, you'd use that formula of monthly rents times 165 equals your property's value. Or if you want to use 180 or a different number, that's kind of where your property's value is, or what you might be inclined to pay if you're in paying market. The lower the number, the better. So if you see a gross rent multiplier with 100 out there, grab that puppy. So how does this apply to what your actual choices are in the market right now? In Ada and Canyon County, we've got this many active fourplexes right now. And the Corey Lane floorplex, that one is a really good price. It's going to make someone happy. The rents, your return's going to be really good on that one. It's $850,000 for a fourplex, and it's in Boise. The gotcha on that one, because we're always about it analyzing, right? So what are the gotchas? The gotchas on this one is there's no HOA. Who says yay? Somebody says yay, yay, but there's 2 fourplexes per parcel. Okay, so that means we really need a shared maintenance agreement on the road, on any shared things, which is going to be your parking lot, your trash enclosure, your trash removal services, any of those shared things. And that can be done, and it's doable. It requires cooperation and someone to take initiative. A lot of times the last one I did and helped put together happened at the sale. We had a seller who wanted to sell, a buyer who wanted to buy, and he's like, yeah, I'll take it. Yeah, you don't have to fix anything, but I want this figured out before we close. And so as agents, we got on it and everybody played nice and found their attorneys, and then we got it done before closing. So that is something you want to watch out for, because a lot of times you might expect to drive to that one and see the parking lot looking a little bit like it needs to be resealed. And nobody's individually like, hey, I want to spend some money resealing a parking lot today. What else looks good? Well, that ski jump, there's a couple newer fourplexes like ski jump, and I like the age, but there's that Utah group that has come in and they force you to use their property manager, and their manager manages the HOA and all the rentals. So you have closed management. And some people may be okay with that if you're not, committed and loyal to your manager, but you also have to be happy with the practices that particular manager has. So one of the screening questions to ask is ask yourself first, and then ask them, are you doing showings without a human? There's another way to say that, but not even just virtual showings, but like some bunch of security, driver's license, access code, and now you, a tenant, go into the property all by yourself, show it to yourself, and then maybe the access code expires. Obviously, I don't know exactly how they're doing it, but there is a trend in these unaccompanied showings out there. And as an investor, you need to think about, do you like that? Do you dislike that? Are you going to tolerate that? Tony's not going to tolerate that, that's for sure. And is there some incentive to help you tolerate it? Like, okay, but I'm paying 2% less in management fees. So if I ever get vandalized, maybe the numbers work. I don't know. So some questions to ask yourself about those. But Corey's priced well. Brogan is a cash only fourplex. And so we don't love the way they're built. And also, maybe you have the cash, but maybe when you go to sell, it won't be a cash heavy market. That's just something you got to think about your exit strategy before you buy something that has major constraints like cash only. And Blodgett has really good upgrades and it will sell. I'd really like Blodgett, but just for a little bit less money. And here's our 5+. So we actually have inventory in the 5+. You've been here before, and usually sometimes this is like 3 properties. There was one that caught my eye on Merchant, that one, I can't get any financials on it. I requested them. So they're like, well, look at our flyer. Well, I like to look at raw data and numbers and make my own pro formas. And so if somebody was really interested in that one, it seems like there's going to be some hoops to jump through in order to get what we need to analyze it. But, maybe we call that sweat equity. But that one looks really good in terms of what you get because it's 2021 built. How many units? 12 unit property. It's 3 stories, so it's a smaller footprint, but looks, the numbers look pretty compelling on that. And so what it is it's a 4.9% cap rate, near 84, 4.9 for 2021 build. Not bad. The GRM is 185. And again, for a newer property, only 1 year old, you'd expect some downward pressure on those returns. Thatcher, that one we saw at the beginning, the 22 units in the north end, that one has a 183 gross rent multiplier. You can get it down a little better because there's some room in those rents. And the market cap rate, and the cap rate on current rents is 3.5%. And that Geckler property we looked at earlier, that gross rent multiplier is around 210 with some room in it. And it's currently a 4.3% cap rate. So to get pretty much brand new in Nampa, but 4.9 cap isn't bad. Otherwise, maybe you want to go to Thatcher and use market rents and get that one up. But there's some stuff, and this is about what it looks like. We're still seeing really around 40%, 35% down payments with these interest rates to break even. So you'd probably refinance down the road or buy cash or whatever, but those rates are really affecting your return on investment, where you got to come up with a lot of cash to make sure you're not going to be reaching into your pocket each month. So the rates are key. What are they doing? And here's a list of what all the rates are doing. So 6.375 is your single family rate today. That's down from like the 7s. Not bad. Yes. Non-owner occupied is a little bit more. Oh, yeah, we would recommend the ARM loan for non-owner occupied and just refi down the road. 7.25% is the best you're gonna get on an ARM loan for non-owner occupied single family. And if you wanted a 20-year ARM, so you could have plenty of time to refi, there's only a small bump for that, 7.375. So you're paying just a bit more for the security of plenty of time to wait for rates to be better. And then when we're in the duplexes and fourplexes, non-owner occupied, that's 7.625. Oh, and that unwarrantable condo, because you have to put 20% down, that condo, you're looking at 6.625 are the rates that rough rates that I was calculating for that around. Actually, the payment might be a little less than 2,500 because I think I ran the rates a little higher on that. But the tenants are still out there and they're still paying rent, but affordability, we always talk about, how that's going to go. But inventory is increasing in the rental market side of things. So the rental listings have doubled since last month, more coming, more showings, which is good. If we have more inventory, we want to have more renters looking at these. And their average days on market at first rate is around 21 right now. So things are still moving. Cat says, we expect the market will continue to heat up in April through July, but I don't think we'll see rent rates quite as high as last summer. She says that the rental market already seems more saturated than usual lately, which I expect is due to a large number of homeowners who couldn't sell. And so they ended up renting it out. And we had a couple of those. If you were here in November after October, I'm like, oh my gosh, suddenly everything stopped. We just told our clients, hey, maybe we should rent it out. And so we made that recommendation as their agents went for a couple properties that were just not moving. So, okay, so for the new rents, if you're having a new rental this spring or summer, it won't necessarily be worth less than it was last year. It'll be close to what it was last year. But we're not going to see those again, those $100 and $200 or $200 rent increases as leases expire. So if somebody's already at market rent, it's a good time to leave it alone. If they're at market rent, and market rent from this summer to last summer hasn't changed much. And it's also a good time probably to avoid a vacancy since there is more inventory. So now is the time to back off and let it do its thing. So the average increases that First Rate's been putting out there for the rentals is $25 and $50 a month for May, somewhere in there. And most of their rentals are near market rents, which allow them to not have to increase it drastically as well. So will owners try to thwart or curb days on market by lowering their rents? What number of days on market is going to incentivize you as a landlord to try to undercut the competition to get them to rent your property first? Seems like a smart tactic, but things like that can pull the rents down overall. Everyone else will watch the comps. So we'll see if that happens, but it doesn't seem drastic at this time. Any questions on the rental market or market update so far?
Are you seeing a big difference in single family homes versus the multi-unit days on market or inventory increase? Fewer people renting for more troubles in the fourplexes and multi-units in the big apartments.
I'm not sure, Alan. I'll have to ask Kat that since I'm not as boots on the ground on the rentals. I can show you what the rent data looks like, and I will right here, so you'll see those prices. And that's a really good question. What I do know about First Rate's take on single family versus multifamily that we've talked about recently is they are gravitating toward more single family rentals lately. So there's just been more of them coming on, more tenants absorbing them. But in terms of which one's performing better right now, let's look at the Q4 rental market data. We don't have the new data yet. We'll have it next month. So this would be the fourth quarter of 2022. NARPM does their big survey. And so what we can see on here, at least from we can see what they're doing rent price wise, but they really kind of average the vacancy overall. So I don't know which one's having higher days on market. But I can tell you, for example, a multifamily 2 or 3 bedroom is in Ada is going to be, close to $1,500 to $1,700 or $1,800, whereas a 2 to 3 bedroom house is going to be like 17 to 19. And I think the individual price will have a big impact on that. And also with the multifamily, if you're part of like a complex where there's a lot of the same, depending on what else is available in that complex. Anyone else have a thought on whether does anyone have a single family or multifamily that where one seems to have faster days on or better days on market right now? Yeah, it's a good question. Stumps us. Okay, and then I just want to go back to this one. I kind of skipped it, but here's your historical vacancy trends overall. And the different colors are Ada County, Canyon County, and the 2 combined. And you can see the trend lines are pretty, they're all doing the same thing, but red is multifamily. Oh, this is the slide, actually, the one I skipped. Yeah, your multifamily. And your single family is green. So on this, it does show us that the single family tends to have higher vacancy than the multifamily, but sometimes they really bleed together. And as of Q4, it looks like they all kind of bled together.
Big slide.
Yeah. So there we have it. Okay, well, that is our market and our rental market update.